Welcome to today's Explainer. I'm putting on my senior macro strategist hat today because we are doing a deep, meticulous analysis of how a high-performance blockchain is aggressively challenging traditional financial intermediaries. We are cutting entirely through the crypto hype here, and we're going to analyze Solana purely as a piece of global financial infrastructure.
Right off the bat, here is the core thesis you need to understand. Solana is not a bank. It doesn't offer deposit insurance, it doesn't underwrite credit, none of that. Instead, it's a high-performance public chain with one massive goal, making the transfer of value instantaneous and completely programmable. The entire premise is that global settlement should feel exactly like sending an email or a text message, just data moving seamlessly over the internet.
Okay, let's dive into this. We've got a very logical progression for our macroeconomic research framework today. First, the core settlement problem. Then, Solana's technical architecture, followed by real-world settlement pilots, the disintermediation of traditional finance, our macro valuation framework, and finally, network risks and challenges.
So, Section 1, the core settlement problem. To really grasp the solution, we have to recognize why traditional finance is broken in the first place. Put simply, traditional settlement is just a gigantic coordination problem weighed down by isolated, legacy ledgers.
When money moves the traditional way, it's navigating this incredibly frustrating maze of banks, card networks, clearing systems, custodial layers. It's a lot. And this creates 5 huge frictions. First, settlement is just agonizingly slow. Second, moving money across borders is insanely expensive. Third, and this is absolutely crucial, intermediaries are capturing fees at literally every single layer of the transaction. Fourth, the back-end operational reconciliation is a nightmare. And fifth, global access is still heavily fragmented depending on where you live.
So the current state, yeah, it's fragmented, it's slow, and it's expensive. Solana's goal is to rip out that maze and replace it with a shared, programmable ledger. But here's the catch. A high-performance chain needs a genuinely useful unit of account to solve these frictions. Without an asset people actually understand, it's just raw tech. And that is exactly why stablecoins are the magical missing piece powering this entire vision.
All right, moving into Section 2, Solana's technical architecture. Let's look at how they fundamentally restructured the technological approach to transaction ordering to get this crazy throughput.
And this brings us to proof of history. You know how traditional blockchains get totally bottlenecked because every node has to constantly talk to each other to agree on the time? Well, Solana bypasses that completely. They built a verifiable ordering of events right into the architecture. Think of proof of history like a massive, synchronized clock for the network. It dramatically reduces coordination overhead, which means the system can process transactions in a continuous, high-speed stream. So, what is the actual result of that architecture? Well, the average transaction cost is incredibly low. We are talking roughly a fraction of a single cent. The base fee is just 5,000 Lamports, which is this microscopic piece of a Solana token. Compare that to the hefty fees extracted by legacy payment rails and correspondent banks. It guarantees an extreme structural cost advantage for anyone moving value around the globe.
Just to recap these advantages, we get sub-second confirmation times, that $0.0005 average cost, and composability, meaning your payments, token accounts, and apps can all interact at the exact same time on the same chain. This ultra-low latency provides the exact operational certainty that massive global merchants and institutions absolutely demand.
Section 3, real-world settlement pilots. Now, what's really interesting here is how we are finally moving past the theoretical white papers and actually transitioning into real-world institutional execution. Let's map out Visa's exact progression with stablecoin settlement, because it proves beyond a shadow of a doubt that this software is being rigorously tested as legit financial infrastructure. In December 2025, Visa kicked off a USDC settlement pilot for U.S. institutions, working directly with Cross River Bank and Lead Bank over Solana. And then by April 2026, that pilot expanded across 9 blockchains, hitting an astonishing $7 billion annualized run rate. $7 billion.
We are seeing this adoption hit from 2 totally different angles. On the consumer protocol side, you have Solana Pay, enabling direct wallet-to-wallet transactions, bypassing the traditional card processor entirely. And on the institutional side, Visa is settling billions. Now, this doesn't mean Solana just replaces Visa overnight, right? But it absolutely proves that monolithic traditional networks are actively using blockchains as their back-end settlement infrastructure.
Okay, Section 4, the disintermediation of TradFi. Let's step back and objectively analyze the economic impact here. Who actually gets disintermediated by this open software?
There's a very clear divide forming in the market right now. If your business model relies purely on the friction of moving money, think merchant acquirers, remittance providers, or correspondent banking chains, you are losing your edge fast. But on the flip side, who survives? The ones who adapt. If you pivot to provide essential services like KYC and anti-money laundering compliance, fraud management, or custody, well, then your business model is going to remain incredibly secure.
So the reality of this disintermediation is pretty nuanced. Banks and fintechs don't just magically disappear. But as this settlement layer becomes open, programmable, and wildly competitive, all these traditional intermediaries are going to be forced to justify their fees with real, value-added services. They can't just act like toll booths on a closed road anymore.
Which brings us to Section 5, the macro valuation framework. If you want to take this seriously, you have to stop valuing the network like some speculative meme asset.
To analyze Solana with real rigor, we completely throw out hype metrics. No mean value, no speculative token pricing. We look purely at economic utility. We're tracking transaction fee demand, decentralized exchange volume, active addresses, and the total supply of stablecoins on the network. You really need to be analyzing this the exact same way you would evaluate a global cloud platform or a massive public database that just happens to have native money built in.
So, the real valuation drivers boil down to real economic activity, developer lock-in, durable network effects, and fee demand. The ultimate question for investors over the next decade isn't what's the token price doing tomorrow, it's whether this real economic activity can sustainably outpace the inevitable fee compression and the very real regulatory headwinds coming our way.
And that perfectly tees up Section 6, Network Risks and Challenges. Let's address the institutional counterarguments impartially, bringing some serious data-driven scrutiny to this infrastructure experiment.
We've got 7 core risks to systematically run through. First, network reliability. Yes, past outages have definitely damaged institutional trust. Second, severe regulatory risk around DeFi and self-hosted wallets. Third, fierce competition. We're talking Ethereum Layer 2s like Base and Polygon, plus Tron, Stellar, Avalanche, and even private ledgers. Fourth, fee compression, which limits value capture. Fifth, security vulnerabilities like smart contract bugs. Sixth, an incredibly heavy dependence on centralized stablecoin issuers. And seventh, those vicious speculative cycles that just completely detach price from actual fundamentals.
If we group that risk profile into technical, market, and legal buckets, a really stark truth emerges. Extreme technical performance, processing thousands of transactions for a fraction of a cent, is entirely useless to a major financial institution if it doesn't come with airtight reliability and strict regulatory compliance.
So, I want to leave you with this final provocative thought. The biggest idea we've uncovered today isn't that every bank on Earth is going to disappear. It's that settlement itself is fundamentally shifting to open software. But to pull that off, this network has to mature significantly. So I pose the question to you. Can Solana become reliable enough, compliant enough, and useful enough to move real payment and settlement activity at a truly global scale? Thank you so much for joining me on this explainer. Keep analyzing, keep questioning, and I will see you next time.